I know that you've been overweight on the US all year. We've got quarterly earnings season coming up. To what extent are you worried about these earnings weighing on the market, about companies not doing as well now as they did in the same quarter last year?
So, good morning, Mariam. Thank you for your invitation. It's true that we are entering the earnings seasons in the US, which is one of the concerns that investors have currently. We at Natsuki have decided to increase this week our allocation to equities as a whole for the balanced portfolios, just because we think that all these fears of investors of a bad earnings season is already priced in. I mean, stocks are not really expensive today. They're not cheap, but they are not really expensive. But the thing that we like very much with equities, and especially US equities, is that you have an economy that is growing, and we saw yesterday the report from the Beige Book. It's not spectacular growth, but modest growth, which is very good for equities, and especially if you choose the right sectors. So we have increased equities. We like very much US equities, and especially these sectors linked to the domestic economy, shale gas, shale oil, and also technology stocks, of course, industrial companies, which are all the sectors that we like. So we are not really concerned about the very bad earnings seasons. And the other thing is that compared with other asset classes, equities are relatively cheap today. So if you take equities just on their own with a PE of 14 to 15 times earnings, the market is fairly valued. But if you compare equities with the rest of the possible investments for individual investors, equities look really attractive to us.
So equities are attractive to you, and as you say, you've increased your equity holdings. Just to clarify, to pick up on your point about US stocks, you're saying that you think lower earnings are already priced into these markets. Does that mean that you think we could actually see stocks rise as earnings fall?
So, well, we don't expect earnings to fall, but there might be some disappointments on some specific sectors or eventually specific companies. The thing is that with QE3 that has been implemented recently, we have seen the market go up quite sharply and all other risky asset classes. Now, due to this earnings season, but also external factors like China slowdown or Turkey, Syria troubles, and Europe and fiscal cliff, US elections, the market seems to be wobbling a little bit, and it might last for maybe a few more days. But we think still that this market in the US is fairly valued. It's not cheap, it's not expensive, but we like the fact that compared with other asset classes, once again, it is extremely attractive to buy good companies exposed to global growth, because the world is still growing and that pay you a dividend, whereas you don't get any return on fixed income investments, most fixed income investments today.
So does that mean that you're staying away from government bonds? What about corporate debt?
So yes, we stay away from government bonds, at least those that are classified as safe havens. I mean, the Swiss, the Dutch, the German, the Denmark government bond that provide you with nothing, no yield at all. And I think that there are lots of investors that misprice the risk in these bonds. The risk of on the downside is quite big in our view, so we stay away from that asset class. On corporate bonds, we also are pretty cautious today. Investment-grade corporate bonds are extremely expensive in our view, because even though you have some spread compared with government bonds or relative to swaps, the absolute return that you get on these corporate bonds is pretty low today, and in our view does not reflect the risk that you take by investing in these corporate bonds. So this is on investment grade. We still like high yield on the short duration, so non-investment grade corporate bonds. We think that there is still some value, because you get north of 5% yield on these short duration high yield with less than 2-year duration, so that's fine with us. But one must not forget that this is a high yield and this is not corporate investment grade, so you don't, the risk is not the same. And to end up on fixed income, We said the last time I talked to you that we liked very much the emerging market investment grade corporate debt. We still like it because you have more spread than their equivalent from developed markets. But we think that the market is a little bit complacent today because we've seen that many new issues, I would say tons of new issuance by these emerging market corporate recently, and they've been swallowed by the market very easily. So it looks to us a little bit pricey today.